All right, now I'm sure a lot of you guys are gonna think I'm full of but Fannie Mae and Freddie Mac, which are basically like the mommy and daddy of almost all mortgages that are done in the country, they are now literally charging you more if you have better credit or a larger down payment versus having worse credit and less down payment.
Say what?
Now, before I dive into that, do me a huge favor, hit that like button, make sure you're subscribed to the channel. All right, now let's talk more about this craziness that's going on in home lending with Fannie Mae and Freddie Mac and the adjustments that they have made to what they call loan level price adjustments, which is basically like a menu of if you got this credit score and this down payment, this is what it costs to get that interest rate. And those costs are gonna vary. Now, if you go back in time, the way that it usually worked was essentially that the better your credit or the bigger your down payment, the better the interest rate that you would get as a buyer or somebody that's refinancing an existing mortgage. But that's not the rules of the game anymore, guys. The way that it works now is in many cases, you get a better deal if you've got worse credit than the person with a higher score or a bigger down payment. Let me give you a few examples, okay? Now, I'm not gonna waste everybody's time with, dissecting this entire thing because there's just too many examples. But let's say that you're putting 5% down and you're comparing your deal to somebody that's putting 20% down. Well, isn't 20% less risk? Shouldn't that person get a better deal? No, they're actually going to get a worse deal. They're going to be charged more for putting more down, okay? And that's just based off of the down payment. But let's step this up a notch. Let's say that not only are you putting less down, but you've got worse credit. The person that's got let's say a 661 FICO score putting 5% down, they're going to get a better rate than the person that's got a 739 FICO putting 20% down. Now, I know this sounds like Alice in Wonderland. Up is down, down is up, opposite day, whatever. But like I said, I don't make the rules. I'm just telling you how to play the game. And this is the rules of the game in the world that we live in. You as a potential buyer or even somebody that's got a mortgage and you're refinancing, for a long time, the thought process is that I need to put as much down as possible and have as good of credit as possible, or I can't make this happen, or I'm not gonna get as good of a deal. It doesn't work that way anymore. So food for thought, maybe you should put less down. Maybe instead of putting 20% down, you should put 5 and keep the 15 and do something else with it. Leave it in the stock market or whatever. I'm not a financial advisor and I don't play one on YouTube, but the argument could be made that your money is better spent elsewhere if you're going to be penalized and pay a higher interest rate for putting more down. So that's the world we live in. Check out my other video about PMI. I know that a lot of people are worried about how much PMI costs, and in fact, it's really cheap. In fact, if you've got great credit, it's ridiculously cheap, which further pushes the argument that you're better off making a lesser down payment than making a larger one and having a higher rate. If you got questions about this, put them in the comments below. Maybe we'll make a video about it. We'll see you on the next one.